The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem. All right, joining us now to discuss the crypto markets is Joe Ayoub, digital asset analyst at Citi. Welcome to the show, Joe. So Bitcoin's paring losses after the consumer price index rose about 0.4% in October, far slower than expectations, which were at 0.6%. The annual pace slowed to just about 7.7% versus estimates for 8%, and now down from 8.2% in September. So maybe you could dive into what we've been seeing with the crypto markets, especially we've seen them perk up over the past half day, but significantly down from where they were at the beginning of the week.
Yeah, it's been quite a rough period. And I think that's obviously catalyzed by likely a lot of balance sheet selling from FTX and Alameda, and a lot of covering of liquidity as people try to pare their own losses. But as you said, CPI coming in, which we mentioned in our report, would be quite a key catalyst today, and obviously coming in lower gives the market a bit of rebound. But we're yet to see how sustained that is. I think the broader contagion of this event is still playing out, and as your previous guest had mentioned, there's still a lot of facts yet to be relayed. So I think it's a wait and see cautionary play.
Thanks for being on, Joe. There's, of course, this question of whether or not the Fed has finally reined in inflation. Obviously, if it's coming in at 20 basis points lower than expected, one can almost assume that they're doing their job. However, is that really the case, or is it just a lucky break this month? Do you think that the market has the sentiment that the Fed has finally reined in American inflation?
Ultimately, I think it's hard to say. It's not my speciality of focus. What is definitely, what is likely the case is that inflation is probable to remain elevated for a prolonged period of time, which is what the Fed themselves have noted. But I think we're yet to find out whether they've truly reined it in, and I think it will be more of a scale for the longer term over the next year or two to see how elevated inflation remains.
We also noticed you wrote a report on this FTX drama. We're seeing FTT, the native token of FTX, dropping 90% as BNB, the native token of Binance, the largest crypto exchange in the world, is outperforming. So why is BNB succeeding where FTT failed? They're both native exchange tokens.
I think ultimately Binance is a far better, it's easy to say in retrospect, of course, a far better run exchange. But BNB has been outperforming Bitcoin for the better part of a year and a half now. And I think that's partly because A, they capture the majority of users, but B, I think the value accrual into BNB is probably far better than that into FTT. And of course, now we're finding out about the collateralization of FTT and how Alameda were using FTT as collateral on their balance sheet, which of course was CoinDesk that originally wrote that story. And I think actually that also has something to do with it, right? Because the FTT collateral management from FTX and Alameda has likely been in play, or has likely been in play for the last 6 to 12 months that this has been going on. So that sell pressure has probably also manifested over a longer period of time. And that's also contributed to the differential of outperformance from BNB to FTT.
So, Joe, what does the loss of FTX mean to the overall market structure? Here you have one of the largest exchanges in the world now out of play, now out of providing liquidity and the like, and also in the perpetual futures markets, gone. So what does this ultimately mean? We've seen muted volumes over the past several months, if not a couple of years. What now?
Is that what now for volumes and for exchanges, or do you mean what now for the market?
Both. Actually, it was for volume and exchanges, but sure, we'll also say for the market.
Well, I think obviously now Binance take a significantly lion's share of the market, but part of what we discussed in our note and part of what we wrote about a few months ago is following these contagion events and following big dramatic centralized failures like Celsius, like Voyager, like BlockFi, users are going to be far more aware of self-custody. And I think that is going to be a significant trend going forward, is the increased use of decentralized exchanges. So far, month to date, we've seen a 30% increase in volumes from decentralized exchanges. We've seen DEX as a percentage of SEX volumes increase by a few percent. And also, I think that's going to be the most impactful trend going forward, because centralized exchanges, while the differential between how they may be used between each other might change, I think the overall flow to decentralized exchanges might increase, and that's quite a major change for the space.
Interesting. You also wrote another visible trend is the underperformance of coins relating to FTX and Alameda, in addition to FTT such as Solana, Serum, Radium, and Aptos. And I suppose on the Solana and Aptos tokens, how low or how long do you see them taking to bottom out?
I think it will take a significant amount of time, and I'm happy to be able to bring you breaking news in that Sam has just tweeted about 10 minutes ago, and he explained that they apparently have more reserves, at least collateral, than their liabilities for customer deposits. But I think ultimately, if that was the case, then they wouldn't be looking to raise funds. And I think that's manifested a lot in the price action of their coins, right? If you look at how these coins related to FTX have performed, it's performed quite badly. And I think it was 1 million tokens that are unlocking today for Solana, and over 50% decline in less than 48 hours. How long it takes, I think it will take a very prolonged period of time for this all to play out. I think that's largely because of a lack of trust from users in these projects that are related to Sam, that have been funded by Sam, which will take a long time to regain. You know, trust is gained over a decade but lost in an instant. And I think that's the case for these coins as well.
Joe, do you see this contagion contained within the crypto markets, or is there a risk of it spilling over to the broader market?
Yeah, that's a great question. I think primarily we've seen decorrelations between the SPX and crypto, and that for me is a very positive sign. The fact that there isn't broader spill on, there isn't broader contagion in equity markets so far, that's something that we mentioned in our note. But you know, I think different to Celsius and different to Luna is that there were institutional investors in FTX and in FTX funded projects, and we're yet to see how significant those losses are. Again, as your previous guest has mentioned, we need to see what the actualities of this process is, how it plays out, and how investors are ultimately and customers are ultimately compensated for what's gone on. After that, we can then discuss contagion events. But we'll see is the answer.
Joe, as you mentioned, the institutional investor.
Following up on Christine's question, yesterday there was a very striking Wall Street Journal article that framed this in a way that I have not really seen before, you rarely see, which was just basically like, you know, thanks to the turmoil in crypto, you know, major sell-off in the stock market. Do you think that narrative is correct? Because usually it's the other way around, right? Usually we see, you know, there's a sell-off in stocks and that affects crypto, but this is a rare occasion where you actually see people attributing the crypto turmoil to, you know, the Dow falling. Do you think that narrative is accurate? I mean, obviously not the only reason, but it was one of the main factors cited. Yeah.
Yeah. I would be skeptical of that narrative, largely. I mean, if you look yesterday, while crypto was down 14-15%, the SPX was up on the day quite significantly. So I think the only thing that could be a overlap between the two is consumer confidence, potentially, and you know, sentiment from retail investors and retail users. But as for broader markets, I mean, look at the major market, right? Like we're looking at a market that's $800 billion in market size, and we're looking at an equity market that's somewhere probably closer to 40 trillion, and a bond market which is significantly larger than that. So if you actually look at the sizes of Bitcoin and ETH in comparison to the top 10 S&P constituents, they don't even make the top 10. So I don't see a massive overlap in that sense, and I think that would be a highly improbable scenario.
So, Joe, before we go, you mentioned institutional investors and the effects on them. But what going forward? Do you think that this particular instance maybe scared them away for good? And I'm talking about the smart money that had invested in FTX over the past couple of years. Do you think that going forward, they're just going to be like, well, you know what? This is just clearly ridiculous. We don't get it. We don't trust these people anymore. We're not putting any more money into this industry.
It's a very real possibility. This is one of the most devastating events that's happened in crypto in its history, I think. And again, your previous guest mentioned Mt. Gox, and Mt. Gox on a notional scale wasn't as devastating as this. And this is a highly shocking event. So, it's very possible investors that have, if they don't receive any compensation, if FTX doesn't survive, it may be a case of, okay, like we tried our hand here. And that's also the case for Celsius and Voyager and BlockFi and a lot of other centralized entities that have been funded by, larger investors. So I think long term, I'd hope for that not to be the case, simply because I believe there to be some utility going forward for digital assets and how they can be utilized. But especially given monetary tightening and a broader negative economic sentiment, it's definitely a real possibility that investors are fearful over the coming years.